Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager and education coach here at Schwab, and this is Managing an Options Portfolio. And in this series, we've gone through a lot of the strategies a lot of you are familiar with: vertical spreads, iron condors, butterflies, calendars, diagonals. But can a trader just make up their own strategy? That's actually a question that came up in one of my YouTube comments just this morning. I was answering a comment. Somebody said, "Hey, Cameron, you talked about butterflies. What if I did something a little bit different? Would that be better?" That's a great question. We're going to be talking about maybe creating our own custom strategies and just weighing the pros and cons of those. Now, quick answer to the person who posted the question: better always depends on what happens after the fact, right? But let's get into this. And as we do, I first of all want to say hello to everybody that's already chatting in. Hello there, Rice Burden, Will, David, Bill R., Josh, Robert, Randy, everybody else. Eva, thanks for joining us week after week. We really do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, if you're watching a recording of this session, enjoy the presentation. Be aware that you're invited to join us in the live discussions. This is a Wednesday series. There is a change coming to the series. You need to be aware of that. The webcast kicks off noon Eastern. We'd love to have you here in the live stream if you'd like to be here. And I also want to let you know that Brent Moores is hanging out there in the chats with us. Brent's going to be interesting. Any questions that I can't get to just during the natural flow of the presentation. Thanks for having me back there, Brent. You know what? I'm going to skip a little bit ahead here since Brent's here. Brent's actually going to be taking over this series in 2025. That's among the calendar changes that we have coming up. So my calendar has changed significantly. The different webcasts are being taught. I'll give you an update on that later in the session. Anyway, but let's get into today's discussion of just making up strategies. All right. As we do that, the first thing we need to do, of course, is to pause to consider the risks associated with investing. Risks are real. These disclosures are important, so bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So here's the agenda for the day, as it is typically for each week. But each week we always take that agenda and we take a little bit of a different approach to it. But in this webcast series, we manage an example portfolio of paper money options trades just to sort of learn management techniques along the way, discuss the pros and the cons of the strategies. So the first thing that we're going to do is look at our existing positions and see if any of those need some maintenance. And spoiler alert here, yes, there are. We're going to be making some changes to our existing positions. Then we're going to look to add a new trade to the portfolio. Before we do that, we need to take a look at current market conditions. Then we'll add that new trade using examples on the platform. And this is actually going to be the strategy that was proposed to me in a comment on a different video from YouTube just this morning. So we're going to look at that. We're going to break it down, see how it might actually work. It's not actually a strategy that has a recognized name. That doesn't mean that it's not potentially a viable strategy. It also doesn't mean it's not a strategy that carries its own unique set of risks. So that isn't a strategy that carries its own unique set of risks. You know what I'm saying? Anyway, there are pros and cons to it. But let's go look at the thinkorswim desktop platform. Here are our 6 existing positions: Amazon right on down through Walmart. I think we're going to be making a change to a few of these, starting with Amazon. With Amazon, we have a bull call spread. Sold the 210 calls, bought the 205 calls. When we buy the lower strike calls, that creates a bullish trade where we'd like to be above our spread. So in this case, we'd like Amazon to be above 210 as we move toward the 20th of December expiration, which is in 9 days. And you can see that we're well above 210 right now. We're at 230. So with a $5 wide spread, what we're really looking to do, we purchase this for about $3.45, the difference between $13 and $9.55. We're hoping our $3.55 will grow in value to around $5. And look at where it is right now. The difference between the two strikes now is right at $5. So there's really only about 5 cents left. It's about $4.95. Not really much left to be made in this trade, even though we hung on to it through December 20th, through those remaining 9 days. He was saying I would consider taking about half profit on Amazon, and we could, right? We could scale this position back. The trader might decide to get out of some of the trade. They might decide to hold on to all of it. This is a debit spread. So it's not that we'd be sidestepping, let's say, commissions, because with a debit spread, we're looking for the contracts to be assigned and exercised. So there'd still be the commissions at the end, whether we close out now or we wait till expiration. But just to show you that on a chart, here are our 2 strikes. I've just drawn in some lines here, and I've drawn in a green box to show where we'd like to be. And you can see how far we've penetrated into that maximum theoretical gain territory. We're well above that 210 level. Good distance from a loss position. That doesn't mean, though, that Amazon couldn't completely course correct and crash right on down, give away all of our profits, and move into loss territory by the 20th of December. So with so little to be made in a vertical spread, the way it works is as there's less and less to be made, there's more and more risk in the trade. It goes just like that. So I think what we'll do here, rather than scaling this back by half, which was actually my plan this morning, but it's gone even better today, I'm going to take it down to just 1 contract. I like to leave 1 contract on just to give us something to talk about. You know, if it goes south on us, there's a learning opportunity there. But a trader might look at this and say, you know what, there's hardly anything left to be made here, 5 cents or whatever. Let's right click here. Let's create a closing order and sell out of that vertical spread. We're going to leave 1 on. So let's just dial this up to just 10 that we're closing out. And let's say that we're willing to do this for a 490 credit, pretty good spread between the bid and the ask price. Let's see if we can get filled. Not entirely sure. We can't always be confident. We have to see if the order will actually fill with a limit order. But let's click confirm and send. Selling out of that vertical spread, 490 limit. That would be cashing in just about at the maximum theoretical gain. Don't pay attention with the max profit, max loss. These don't matter on a closing transaction. It's still calculating those as though we were opening a trade. We don't worry about that. But something we do need to pay attention to is that we have a commission here. But let's send this order off, see if we can get filled. And while that's working, let's go back and look at our next one. So next we have Salesforce, which is a long call. All right, looks like, yep, we got out for 490. Great. So it didn't quite get all the way to $5. We got out at 490. But with Salesforce, we just own some long calls. Now, we've sold short calls against these long positions in the past, closed out those short positions. But we bought these calls for $31.90. They're now worth $93.48 because Salesforce is just screaming upward. So it's been great for long call ownership. Let's look at that on a chart. You can see stock has been bouncing, making higher highs and higher lows. We're all the way down here at this strike. This just represents a previous resistance acting as a potential new support. But overall, we just like this. I know that our green, let's activate that because we could make even more money if the stock just continues going higher. But a technical trader might look at this and say, well, we own a long call. There's been a pullback over recent days. It's interesting that we pulled back again, maybe down to a previous resistance level. Bouncing off that, is that a possible new support? And if it takes off again, what could that do for our call? Could pile gain on gain. Now, if we break through that support, if the stock goes down, we could start to surrender some of those gains. So Eva says we could just get out, couldn't we? There's still 100 days left. Could do that. And as a matter of fact, we've scaled this position back over time. I think I'm going to leave that one alone. I actually, originally this morning, I was thinking of doing something different with it. Nope. The way that's behaving technically, I think the technical trader might make a case that it's about to make another run. It might not, of course, but I think we're just going to let that one work. So next up, we have Google, which is a long call vertical spread, 165, 182.5. We'd like to be above 182.5, and we're closer to 192.5 or 192.5. Anyway, yeah, so that one's doing fine. Only one contract. I think with that one, I'm going to let that one work as well. It's a $17.50 wide spread. So we'd like to see the difference here, but get to as close to a 17.5 as possible. And it's pretty close. It's about $17 right now. All right, with Microsoft, we have a condor. Let's see what's going on with a condor. Yeah, it's still misbehaving a bit. So this was this last week's? It was 2 weeks ago. Yeah. So I wasn't here last week, but 2 weeks ago, we put on this condor, and a condor, much like an iron condor, with this, we'd like to be between our two short strikes, between $410, $440. We've slipped actually outside of that. We're up at $450. Only 9 days left in these contracts. That's not good. So we're underwater on this one. And boy, accelerating in the wrong direction. We'd like to be here between 410 and 440. We're going the wrong direction. How many contracts do we have? We have 4 contracts. I think what we might decide to do here, let's take off half of this position, stop the bleeding on that half. It'll be realizing a loss on that half. But if we go to reversal, if we can just sneak back down below 440, we could be back into maximum gain territory for the remaining 2 contracts. So let's do this. So this one I wasn't planning to touch, but since I didn't do anything with Salesforce, let's scale this one back. Right click, sell that condor. And let's dial this to just 2. Looks like, yeah, good spread. When we're dealing with multiple strikes, it multiplies the spread. Well, basically, we add up all of the spreads between the bids and the asks, between the bid prices and the ask prices, and it can create quite a spread between the natural and the mid. I don't know if we can get this get a $1.22 credit. What if we went halfway? Let's go for maybe an 85-cent credit, trying to get out of this condor. Greg is proposing, could we leg out of other parts of this strategy? Certainly could. That creates just different reward risk scenarios for whatever's left. So we just have to examine that. Don't really have time to get into that today. I want to focus on today's strategy that was proposed by the YouTube commenter. But let's see if we can get an 85-cent credit for these contracts here in net. Let's click confirm and send. Selling out of those 2. Trying to get 85 cents. We'll see if that fills. It's not a guarantee. There is a commission here. But what we're hoping to do here, stop the bleeding on 2, realizing, yes, a loss on those 2. But hopefully the other 2, we can get a little bit of reversal. And we can talk about it even if it doesn't. Talk about it next week. Okay, there we go. So it looks like we got out for $1.15 instead of the 85 cents that we were requesting. So kind of an accommodating exit there. But let's look at NVIDIA, which is a bull call spread. Here we bought the 130s, sold the 135s. We'd like to be above 135, and we're above 135 right now. We're at 139. Trade's doing pretty well, up $495 so far. We'd like to get to $5. Right now, it's looking like we're closer to $4. So still some room for potential profit. Let's let these continue to work. But that obviously carries with it the risk that if we reverse, go the other direction, we could take a bit of a setback there. But finally, we have Walmart. Walmart is a bull put spread. Sold the 85 puts, bought the 83 puts, collected 45 cents. We're looking for this to shrink down to 0. Well, it hasn't shrunk to 0, but it's shrunk down to about 1 cent. That's just about as close as we could get without actually getting to our theoretical maximum gain. So with this sitting at 95, we're solidly, $10 above our upper strike. Some traders might say, you know what, I don't care about the penny. Maybe the penny plus avoiding commissions, I might hang on, see if I can just let this expire worthless. There is a big risk in doing that. We have $1 that could be made on each contract here. That's how close we are to maximum gain. With a $2 wide spread, that means that there is $199 at risk at this point. Risking risking $199 to try to get one more plus commissions. Let's close these out. I'm just going to close out a Walmart. Right click. Let's create a closing order and buy those verticals back. So we might be able to get, let's be generous here. Say that we're willing to spend up to 2 cents. to get out of these contracts. Still a limit order. Still not a guarantee that we're going to exit, but let's click confirm and send, buy those back, setting a limit at 2 cents. We'll see if we can get out. So it'd be $6 that we'd be spending plus commissions. That $9.90 is the maximum that we could possibly pocket at expiration if this trade continues to perform. That's the most we could. That's the most additional theoretical value that could be added here by holding on. Now it's a high probability that we can make that $9.90, but trader might just decide, let's just get rid of that. Let's pay the $9.90. An additional benefit here is that it frees up the cash that's being tied up in the trade because of that maximum theoretical loss. That much cash is being held in the trade. So, or in the margin for the trade anyway, but let's send that order off and see if we can get it filled. That's working right now. It's at a penny. We're offering 2 cents and there we go, out for 2 cents. So it took the full 2 cents. All right. So we did make some changes in the portfolio today. And that's what we do when we get together on Wednesdays. We talk about, yes, it's called managing an options portfolio. So we manage the existing positions. But now let's add a new trade. Need to start to rebuild things. And by the way, some of these are going to start to expire in the next week and a half. So we need to flesh this portfolio out so we still have something to talk about in coming weeks. And so I did want to talk about this trade that was proposed by a YouTube commenter. And what they had noted is, apparently, I have to say apparently because their comment didn't make specific reference to the fact that we discussed a butterfly in a previous webcast. But they did ask about a variation on the theme of a butterfly. So what is a butterfly? Let's go discuss that just quickly. Let's go back here to Walmart. We're done with Walmart, out of Walmart. So I'm going to right click here. Let's remove our drawings. Let's just clear our drawing set because we're no longer in that position. But just because we exited, we were in a bullish position that's kind of topped itself out. Is it possible for a trader to say, hey, well, that trade went well and the stock still looks okay. Maybe I'll get back into a trade. Yeah, that's possible. Before we do that, though, let's look at what's going on with the markets, because an options trader who's maybe considering putting in a new bullish trade, maybe they want to make sure that they really think the markets look bullish for the intended time frame of that trade. If it's a bearish, a general bearish outlook on the markets, if that's the outlook that the trader has, it can be difficult, even if they're good at doing bullish trading, to do bullish trading in bearish markets. That's a tough upstream swim. Anyway, so here's the S&P 500. We're moving into the holidays, and the S&P is kind of just behaving as the S&P typically does in holiday season. Doesn't do this every holiday season, but usually this is one of the better times of the year for the bulls. And right now, we're trading just below all-time highs on the S&P. That's an extension of this more than 12-month run that we've had in stock prices. This stretches way back further than that. So let's just suppose, without any really sophisticated technical analysis, that our trader is looking out to maybe adding a new trade for the January expiration, 17th of January, and their personal conviction is it looks like maybe we're going to have a pretty good end to 2024 and a pretty good start to 2025. Is that a guarantee that that's what's going to happen? Nope. Time will tell. But if that's their outlook, then maybe looking at adding a new bullish position to their portfolio might make sense. Eva says, I'm often concerned about butterflies when we're combining a bull and bear spread. That's interesting. Okay, Eva, well, what this person proposed isn't that. So we'll see. Let's see if this looks a little bit more appealing to those who have an issue with the bullish bearish vertical spread combinations, which is exactly what a butterfly is. So let's go to that Walmart possible trade. And I want to talk, actually, let's go back to our chart. I got a little bit ahead of myself. So here's Walmart. Walmart has sort of been chugging along with occasional downside moves, but not very many and not very long. For really all of the last 12 months, with relatively rare exceptions, it's been a pretty bullish stock, sideways at sort of the worst of times, except for right about here. What was that? The third week of July down to about the first week of August. There was one downside move. Other than that, there hasn't been much. And let's just say that our trader thinks that as we're looking out here to January 7th or 17th, maybe it looks like it's going to be another one of those months. Well, we've discussed butterflies before. And a butterfly, if you're not familiar with it, I'm just going to give a brief summary of what it is. A butterfly is just a combination of a bullish vertical and a bearish vertical. It's done on the same stock. So, for example, maybe the trader uses calls to structure their trade. So they set up a bull call spread where they'd like the stock to be above that spread. But at the same time, they set up a bear call spread where they'd like the stock to be below that spread. And if you overlap those two using the same center strike, what that does is it creates a scenario where the trader would really like to be right toward the middle of those strikes. If we want an example, let's go to the trade tab here. This might be just a brief example. Let's go to the 17th of January contracts. And with the stock trading right around $95, a typical construction would be to sell 2 of the $95 calls. Let's use the calls for today's example. So I'm going to click on those $95 calls. And let's say we're going to do 2 of those. There we go. Now we're going to go back up. We're selling those calls. And then to complete our butterfly, we're going to buy a call below the ones that we sold and buy a call above the ones that we sold. So let's say that we buy the 90. Let me open up my quantity here just a little bit so you can see there's just 1 and then 2 short. Okay. And then we're also going to buy the 100 just as an example. So we wind up with selling 2 in the middle, buying 1 below, buying 1 above. What that does is it creates a 90-95 bull call spread, and it creates a 95-100 bear call spread. And where the trader would like to be is right in the middle. Really, the middle strike becomes sort of the target price, where the trader would really like to be on their expiration date right at or near that strike. Because if we're at 95, that optimizes the bull call spread. It also optimizes the bear call spread, theoretically. That is a butterfly. Now, it requires very, very precise sort of target shooting here. We really would like to be right at $95 at expiration. That precision makes it a low probability trade, but it carries typically a higher reward than risk. That's the way options very commonly work. When there's a low probability of success, the reward for being successful typically goes up. It's sort of a teeter-totter effect. Low probability, higher reward. Higher probability, lower reward. So that is our butterfly. And what our trader did, he asked this morning was, well, what if I didn't sell 2 contracts at the middle strike? What if I just sold 1? Let's look at that. So in other words, what they were proposing, here's Walmart again. Let's say we bought the 90 strike. We sold the 95, just 1. And then, let me shrink this back up. I'm just clicking this to get the order out of the way so I can add a new leg, hold down the control key on my keyboard and click on that new leg. So I'm going to click on the ask price to buy the 100. So here's what they were basically proposing. Just buying, selling 1 of each. But Andres is asking, do you set stops on the butterflies? Could. We certainly could. There are pros and cons to doing that. I'm not going to go deeply into the management of a butterfly because that's not today's discussion. But what in the world is this thing that we've created? It's not a butterfly, because a butterfly is a combination of a bull call spread and a bear call spread, which requires 2 long positions and 2 short positions. We have to have a matching number of long and short contracts. This actually results in 2 long and only 1 short call. Naresh says, why not just do a bullish trade on a stock with such a strong bullish trend? Good question, Naresh. Guess what this is? This now becomes, well, if we only have 1 short, but we have 2 long call options, the balance of power has tilted toward the long side. Yeah, this is now a bullish strategy. And so what I wanted to discuss today is that traders should feel free to get creative with the structuring of, fancy little strategies if they want to do that. But really, House says, is this a jade lizard? I've actually discussed jade lizards in the past. You may want to go check out, matter of fact, what one can always do is you can just go to our channel here. Just do a search if you have an interest in a strategy. What do you know? Here's an introduction to the jade lizard strategy with an example trade. And there's your guy. All right. Yeah. So you can check that out right there. But without applying a name to this, and by the way, the system's saying, Cameron, I don't know what this is. We'll just call it a custom strategy. What is it really? This is really what all of options trading comes down to, is just understanding what we are getting ourselves into, what a trader is getting oneself into when structuring a new trade. Like, here's one way to look at this trade. Isn't this still just a bull call vertical? If we buy a 90 and we sell a 95, that means we have the right to buy shares at 90. Someone else has the right to buy shares from us at 95. Hey, there's $5 of profit potential there if this were a free trade. It's not a free trade, but that is a bullish vertical spread right there. So already, Naresh, are there bullish elements to this trade? Absolutely. But we have this leftover here. This $100 strike has nothing to pair up with. So this is just a long call. So we have a bull call vertical plus another bullish long call position. This is net quite a bullish approach. Now, does that mean it's a good approach? No. Does that mean it's a bad approach? Nope. What will determine whether this was a good idea or a bad idea? Well, it depends on where the stock goes from here. If Walmart goes down, what's that going to do to our bull call vertical? Probably not going to do well. What's it going to do to the long call? It's probably not going to go well. If the stock goes up, both these strategies stand to benefit. They're both bullish. It's just a combination of 2 bullish strategies. That's all this is. So the question that was posed to me by the YouTube commenter was, is this a better strategy than a butterfly? Well, it's a more expensive strategy than our butterfly. So in that way, it's not better, theoretically, but it has unlimited upside potential. In that way, it is better. But what if the stock doesn't go up? This strategy can actually fail. So can a butterfly. So it's always what happens after the trade is placed that determines whether a strategy is better or not than another one. Anyway, so how could we sort of skip ahead without really thinking through? What I would suggest is that a trader, if we're structuring a custom trade like this, probably a good idea to really understand what we're getting into. So sort of think through what we're doing. I have the right to buy shares at 90. Oh, I have to sell those same shares at 95. Oh, but I have the right to buy shares again at 100 if I want to. That's really what we're doing. Well, what the trader can also do on Thinkorswim desktop is just right-click on this trade. Once we've structured it, we can right-click on it. And let's do this too. The price is probably still moving around. I'm going to nudge this down, see if we can get this thing filled for a 450 debit. I did that for a couple of reasons, but primarily I wanted the nice round number, just make it easier to talk about. Thaya says exiting a butterfly with a profit is very difficult. It is, Thaya, a low probability trade from day one. You're absolutely right about that. So is that a good definition of difficult, low probability? Probably, yeah. With butterflies, A trader might even look, if we can get anywhere close to that strike price as we to that center strike as we get closer to expiration, maybe the trader looks to see if there's an opportunity to exit with a profit there. It won't be maximum gain, but because there's still time left in the trade. But yeah, just crossing that 95 threshold, going up or going down, just getting to that short strike closer to expiration, that might present a window of opportunity to exit with a profit. Now with this trade though, it's very different than a butterfly. With a butterfly, we want to be right close to 95. With this one, where do we want to be? We want to be higher and higher and higher. If the stock goes up, our long call vertical can make a limited amount. But if the stock continues rising, this one long call that's just sitting there all by itself can make an unlimited amount, theoretically. So if I want to see that displayed on a chart, I can right click here and let's analyze this trade. There we go. So there's our trade. Let me make sure I don't have any relics down here below. Nope, looks good. That's okay. When in doubt, I can just uncheck a few things. But anyway, there we go. So there is our, there's our sort of our risk profile for our trade. So if you're not familiar with the risk profile tool, what this does is it takes whatever you're proposing as a trade. So here's our trade down here. And then it just maps it out for potential for gain and for loss using possible price levels down here across the bottom axis and possible profit and loss levels over here along the side axis or the Y and the X axis. House says, what makes us think that Walmart is so bullish? So House, it could turn around and just turn right around, go back down. But here's how sophisticated our theoretical trader is right now. Well, stock has doubled in value in the last 12 months. Could it keep going higher? Could. For some, an assumption is when a stock has bullish momentum, that momentum is assumed to continue unless something else comes along and changes it. So the initial assumption is just go with the flow. Now, obviously, stocks can turn on a dime and go the other direction, but that's it. That was the basic logic. So let's go back to our Analyze tab and reacquaint ourselves with this. If we're not familiar with it, there are two lines here. So the first line represents the potential for profit if the price goes up. So right now our stock's at about $95. If the price goes up, this blue line is showing us how our trade is likely to perform today as stock prices go up. So if it goes from 95.5 to 96, 97, 98, then we can sort of intersect with where profit levels might be. So this blue line represents today. We can change that to tomorrow if we want to, or 2 weeks if we want to. That can be changed right down here. I don't want to focus on the blue line. Let's look at the gold line here. The gold line, if you can see this number, see it says January 18th. That's the expiration weekend. So this is showing us how our trade is likely to perform as a stock moves up or as it moves down, moving toward, well, on January 18th, expiration weekend. So I can just look at this and throw out some hypotheticals to myself. What if our stock were to pop upward? So it's moving toward our single long call out there, but it doesn't get there. So it's moved, let's say it's moved up to $99. Well, if it's at $99, what's happened to the value of this long call? It expired worthless. We lost the value on that. What about the 90 and 95 long vertical spread? Well, we're above 95. That vertical spread has made its maximum gain. So what's happened here is we made some money on the vertical spread, but we lost our investment in the long call, and that eked out a little bit of a profit, a $50 profit. What if we were at 97? Well, a long call still expires worthless. Our vertical spread is still at its maximum theoretical gain, and we still eked out the same $50 profit. What if we come up short? What if the stock goes down from 95.50? What if it goes down to 93 or 92? Or let's exaggerate things. Let's come all the way down to like $88. And let's just walk through our trade. At $88, we own a $100 call. That thing is way out of the money, expires worthless, right? Lost the investment there. Our long call vertical, well, we needed to be above 95 to be in its maximum theoretical gain position. We're not there. We're actually even below the $90 strike. That thing lost all it could lose. So we lost all the investment in the long call. We lost all the investment in the long call vertical, and we have hit our maximum theoretical loss, which is the investment overall, $450. We've lost that there. So the trader can just sort of walk through. They can talk themselves through how this trade performs at different levels, but also the chart just draws it out for them. Now, notice what happens here as we get above 100. As we get above 100, the long call vertical still in its maximum theoretical gain position. We're still above 95, but now we've gotten above 100 and we're starting to get some value out of that $100 call. So it's adding to the profits on that on the vertical. And how much can it add to those profits? It can just keep going up and up and up and up and up. So this is a strategy where the profit and loss scenario looks like this. It may not be familiar to any of you because it's just one that somebody just sort of came up with. But I think what we can see here is, do we want the stock to go down and lose $450? Or would we prefer for the stock to go up and to go up as far as it can and just see those profits continue to rise? Yep, this is a strategy that's going to perform best if the stock can go up. It's not that it's a strategy that's going to lose money if it doesn't go up, because even if it stays where it is right now, it's still above our long call vertical, and we're still in position to make about $50 on that. Losing the investment in the long call, optimizing the outcome on the long call vertical. So call this whatever you like. I'm just going to call it a custom strategy. There are huge numbers of potential custom strategies that one can build. But what I would suggest you do is, if you're interested in experimenting with these sort of things, go to your paper money, build something custom, and then analyze it. So use the chart, but also try to think through the trade that you have constructed and see if it just makes sense to you that it's behaving this way. All right, but there's our custom strategy. Yes, traders can create their own custom trades. I'm going to go ahead and place this one. This is going to be a bullish trade in our portfolio. As long as Walmart goes up, that's good. We're already above a break-even point on this trade. If the stock stays right where it is, we've already seen if we can fill this for $450, we might have $50 of profit potential, even if we don't budge. It's just those profits start to grow if we can get beyond that $100 level. Scony1013 says, what app is this on? Is this a Schwab app? It is an app that's owned by Schwab. It's called Thinkorswim Desktop. So abbreviate that, it's just called Thinkorswim. You can download it from your Schwab Online account. Just go to the Trade tab on Schwab Online, and you'll see Thinkorswim. Doesn't cost anything to download it. It has a practice version. You'll notice this says simulated trading. So everything that we're doing today is simulated. It also links one to one's live portfolio. So we could, if we wanted to, go place some live trades in my account. I'm not going to do that. Yeah, this is a practice trade. Anyway, let's click confirm and send. It looks like it's still trading. Yeah, it's still in this range. If we were to unlock this, it looks like the cost of it's actually gone down. I'm going to say we're okay. Let's say that we're still willing to spend that $450 debit to get into this. It's a trade with limited downside. We can only lose this much, theoretically, unless we start to tinker with it. Or if assignment, that sort of thing can change the outcome here, depending on how we handle the management of the long positions. And there's unlimited upside potential. Let's click confirm and send. Buying a custom Walmart strategy. The 90, 95, 100 call, whatever we want to call it. There are commissions to be paid on this. Let's do a few more. Instead of just doing the one, let's dial this up. How about we do 5 of these? That would be, instead of a $450 trade, that would be what, a $2,250 trade? Go. Not 6. Let's make that balanced. 5 across all. Let's click confirm and send. There we go. 2,250 is what we're investing here. That's the most we could theoretically lose. Maximum profit is infinite. There are commissions to be paid here. That increases the net cost. Let's send this order off and see if we can get filled. Yep, and we filled at 449. Close enough to 450. Okay, so whatever this thing is that we just created, this custom trade that this other trader envisioned, we now know what it needs to do. We'd really like to get up above 100 and get as far above 100 as possible for this trade to be optimized. Even if it stays where it is, we'll be in position to make 50 bucks-ish, probably 51 right now, with a slightly better fill that we got on the order execution. Anyway, if it stays right where it is, we're still in position to make some money. If it goes down, then all of our contracts might expire worthless and we lost our investment. And we'll talk about managing these trades in future weeks. But we've gone through and accomplished what we set out to do today. I wanted to talk us through the management of existing positions, take a quick peek at the markets, and then place a new trade. And we've done all of that, but I also want to make you aware of some things that are changing. As you watch our webcast, we're going to be giving you the heads up that there are significant changes. We do this relatively frequently on the channel. We shift things up, and we're going to be doing that again at the start of 2025. The webcast calendar is changing, so make sure you make note. Schwab.com/coaching/webcast is where you can find the calendar for our upcoming events. And if you kick it forward to January of 2025, you'll see some changes. And so specifically the impacts to my webcast, this is what my 2025 is going to look like if you're following me. I'm going to be teaching a webcast called Trading Covered Calls and Short Puts on Mondays. A webcast, let's see, was it Getting Started with Technical Analysis? No, Barb is taking that one over. I'm moving to Getting Started with Options. We're doing a little switcheroo between me and Barb. So I'll be doing Getting Started with Options on Tuesdays. And then Wednesdays, we have Getting Started with Thinkorswim. On Thursdays, let's see, what do they have me teaching? Long verticals and diagonals. And then Fridays, we have advanced charting techniques. So good shifting of things for me, mix it up, keep things fresh. I like that. We're experimenting with some new webcast series, and we hope that you'll enjoy those. So keep an eye on that calendar, but also make sure that you are subscribed to the channel so that you can join our live streams. If you haven't subscribed to the channel, you can just pop right down and click on the subscribe button right now. It doesn't cost anything. It literally takes a second. But our Trader Talks Schwab Coaching Webcast YouTube channel is the best place to find our playlists of previous sessions that have been delivered. They're organized by series, so you can follow one topic thread very efficiently, learn just what's important to you. You can, of course, also join our live stream. So make sure that you're subscribed, and also make sure that you're following us on X. You can follow Brent on X at Brent Morris CS. You can follow me there at Cameron May CS. But this is the best place to connect with your favorite presenters in between the live streams. You can even see, you can get, of course, our comments on maybe what's happening with market developments, but even see what we're doing on the weekends. There I am out with Jennifer, out in Moab, Utah at Delicate Arch in Arches National Park. Okay, Dragon Rider, I'm looking forward to 2025 as well. Frank, you're welcome. All right. Yeah, Mike, the old switcheroo. That's what we're doing. Anyway, time for me to let you go. Go enjoy the rest of the webcasts that we have on offer for the rest of the day. Keep your eye out for the changes in 2025. I'll look for you in future webcasts. Thank you to everybody that's already clicked the like button for today's webcast. 42 thumbs up already out of 155. It's a pretty good ratio. But every time you click that like, that feels like a pat on the back to your presenter. It also gives that webcast a boost in the YouTube algorithm, so it helps us find a wider audience for these no-cost educational offerings. So thanks for doing that. Click that thumbs up every time you did enjoy one of our webcasts. Always appreciated. But everybody, I'll look for you in a future webcast. I'll look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.